Hello, I'm Tim Dodge, IABNY's Director of Research and Media Relations, and you're watching Part 6 in our video series, Healthcare Reform, What You Need to Know. Section 18032E of the federal law mandating the creation of state health benefit exchanges states that the U.S. Department of Health and Human Services, quote, shall establish procedures under which a state may allow agents or brokers to enroll individuals and employers in any qualified health plans in the individual or small group market as soon as the plan is offered through an exchange in the state, and to assist individuals in applying for premium tax credits and cost-sharing reductions for plans sold through an exchange. Congratulations! As an insurance producer, you can sell coverage through the exchange. You also get to help people with the tax issues. Now, if that second part doesn't excite you too much, stay with me for the rest of this video. Today's topic is the premium tax credits for which some individuals buying coverage through the exchange may qualify. For reference, see Section 36B of the U.S. Internal Revenue Code. First, let's take a look at who may be eligible for these credits. Taxpayers with household incomes between 100 and 400% of the poverty line may be eligible. For 2013, this amounts to single taxpayers with incomes between $11,500 and $46,000, and households of four with incomes between $23,600 and $94,000. Married couples must file joint tax returns in order to qualify. Individuals who are listed as dependents on another tax return are not eligible to take the credit. So if a couple declares a 20-year-old child as a dependent, the child cannot take the premium tax credit when she files her tax return. Finally, non-citizens of the U.S. who are residing here legally and whose household incomes are below 100% of the poverty line still qualify for the credits. Now, a taxpayer may take the credit for each month she was covered by a qualified health plan in which she enrolled through the exchange and for which she paid the premium out of her own pocket or through advance payment of the credit. However, she cannot take the credit for any month in which she was eligible for coverage from a government-sponsored program, an employer-sponsored plan, a plan in which she was enrolled before the healthcare reform law was enacted, or other coverage such as state-sponsored risk pools. However, she can take the credit if she was eligible for an employer-sponsored plan that required her to contribute more than 9.5% of her household income toward the premium, or if the employer's plan would have paid less than 60% of the total allowed cost of benefits, which would be a plan less generous than the bronze level of coverage sold through the exchange. The amount of the monthly credit is the smaller of two numbers, either the monthly premium for the plan in which the taxpayer was enrolled, or a figure based on the cost of a certain plan offered through the exchange compared to a percentage of the household income. To calculate this second number, the taxpayer must multiply her household income for the year by a factor taken from a table in the law, and you should see a replica of this table on your screen now. The larger the taxpayer's income is as a percentage of the poverty line, the greater this factor is. You multiply the factor by household income, divide by 12, and subtract that from the monthly premium for the second lowest cost silver plan available to the taxpayer. Compare this number to the monthly premium the taxpayer actually paid. The lower number is the monthly tax credit. Here's a simple example using numbers that I completely made up, and you should see the calculation on your screen now. Assume a family of four with an annual household income of $45,000. Our hypothetical family bought a plan through the exchange that costs $1,000 a month, but the second lowest cost silver plan they could have bought cost $800 a month. Their household income is equal to 191% of the poverty line for a family of four. That's $45,000 divided by $23,550. Now, based on the table in the law, we will multiply the household income by 0.059, which gives us a number of $2,655. We divide that by 12, that results in $221, and we subtract that number from $800, which is the cost of the second cheapest silver plan, to get $579. This number is less than the $1,000 monthly premium they paid, so they get a monthly tax credit of $579, making their net monthly cost for health insurance $421. Now note that if their income was $94,000, they still qualify for credit, but it would be only $56 a month, making their monthly cost of coverage $944. And this is because the factor rises with household income. Those who are better able to afford coverage get a smaller credit, and those who can least afford it get a larger credit. However, even with the tax credit, our hypothetical family making $45,000 is still paying 11% of pre-tax household income for coverage. The good news for agents and brokers is that the healthcare reform law requires the exchange to provide an online tool to help individuals estimate their potential tax credits. You're not going to have to calculate this by hand. All taxpayers buying coverage through the exchange should be aware that if they pay their premiums with advance payments of the tax credits, and when they do their tax returns, it turns out that the advance payments were more than they qualified for, they're going to have to repay some or all of the excess when they file. The amount that must be repaid is capped at between $600 and $2,500, depending on household income, again, as a percentage of the poverty line. That's all for this episode. I hope you'll tune in for the next one when I'll be discussing the cost-sharing reductions that individuals may qualify for. Thank you for watching. I'm Tim Dodge.